Let's look at the most important section for a bank's balance sheets. This is what you use to see how healthy the bank is, and the most important metric for you to look at is book value is calculated as total assets minus total liabilities. This value should reflect what the fundamental value of a bank is. Let me quickly run through the balance sheet so that you understand each line item on the balance sheet. Hey guys, it's King Kang. Going forward, I'm only going to speak in English. I'm so sorry for the Korean subscribers. 죄송합니다. 근데 한국 자막이 있을 거예요. So I'll have Korean and English subtitles going forward. For this week's episode, we will talk about our favorite topic, bank failures. First Republic is a privilege to serve you, or it's a privilege to be served. Your worst nightmare becomes a reality. After the failure of two big banks, Silicon Valley Bank and Signature Bank, we saw another giant, First Republic, fail. Our handsome almighty CEO of JP Morgan, Jamie Dimon, decided to acquire First Republic to save the day. How important is this crisis, you might ask? This was the second largest bank failure in the US history. The largest one was a bank named Washington Mutual that happened in 2008, which was also acquired by JP Morgan. Is Jamie Dimon a Batman? Instead of letting the bank to go through another bank run, the government basically brokered a deal to let a large bank to acquire a smaller bank. I do not personally agree with the outcome, but let's see what happened. The most important filing to look at is our quarterly letter from Q1 2023. Let's take a look at the most important section of the filing, income statement, where we can understand how business is run. What is a bank? It's a simple business model where we take the customer's deposit. Basically, you put your money into a bank and the bank lends that money, makes investment, and make a return. We will see as an income. Is it a fair system? You might ask. No. Before the interest hike, you used to get less than 1% on your money, but the banks now make more interest from the loans, and that is how banks make profit off of customer deposits. First thing we see is an interest income. It's pretty simple and straightforward. Loans. You can think of that as loans that bank make, such as house mortgages, debt, loans to companies. This is the main source of revenue for banks. Investment. This is not some YOLO Reddit trades or crypto investment, but this is more stable products like life insurance that gives you a stable return. As you can see, these are the revenue figures for Q1 2023 from both loans and investments. They made $1.56 billion of revenue in loans in Q1 2023, while $252 million of revenue from investment. Let's look at the next line, cost. Interest expense. Again, this is simple and straightforward. As I said, customers put their deposits, banks have to give out interest on the deposits, and this is an expense that we see on the customer deposits. Last quarter, it had $555 million of costs and interest expense for deposits last quarter. For borrowings, we will talk about it more later, but this is another interest expense that the banks have to pay to their lenders. Compared to Q1 2022, you see a large increase in interest expense for both deposits and borrowings. This is because interest rate used to be less than 1%, now it's over 5%. Interest rate increased, hence the interest expense increased. On top of that, they borrowed a lot of money to prevent the customer deposit outflow. One notable thing that you would recognize about First Republic is that they have revenues from investment management fees and brokerage and investment fees. This is possible because they have a large number of high net worth clients, so they make money on the wealth management services. So this is a basic walkthrough of how banks' income statement works. Let's look at the most important section for banks' balance sheets. This is what you use to see how healthy the bank is, and the most important metric for you to look at is book value is calculated as total assets minus total liabilities. This value should reflect what the fundamental value of a bank is. Let me quickly run through the balance sheet so that you understand each line item on the balance sheet. Assets. You can see the cash and cash equivalent, and also debt securities available for sale, debt securities held to maturity net of companies or other entities that can be converted to cash relatively easily. And also same thing with equity securities, stocks of some companies. But the most important part is loans. Loans is the biggest line item. This is what drives the business model. They make loans to make interest income that becomes a profit for the bank. There are various line items as you see under the loans. Single family, home equity lines of credit, single family construction, multifamily. This is basically the same bucket of loans that the bank makes with the customer's deposit. We see that they have $173 billion worth of total loans as of Q1 2023. Investments in life insurance and other items that are not as relevant or large as loans, but are still an asset for the bank that can be converted to cash. Now we go to liabilities. Deposits is essentially what makes a bank run. Deposit, bank cannot run or generate revenue. Deposits come in various forms. Non-interest bearing checking, which is a typical checking account that you open up with a bank. Sometimes you can make an interest bearing checking account, though you might need to have a lot of money in the account, such as few $100,000 and above. Usually this is offered to a high net worth individuals. There's also a money market checking, money market savings and passbooks, certificates of deposits. Short-term borrowings and long-term FHLB advances, senior notes, these are the debt items that the banks take on, borrowings that they have taken from the Fed or other banks for liquidity so that they could have more cash on hand for operational purposes or for investment purposes. Let's get deeper into these line items to understand what book value then means. To make it easier, I have put everything in an Excel. Let's look at how book value is calculated. As I said, you take the total assets and minus total liabilities. The problem with this calculation is that according to GAAP and accounting methods in the US, you do not need to have these assets marked to market, meaning the number we see on the balance sheet is actually not what the actual value of the loan is. Most of the assets they have is obviously loans, as we discussed. Let me walk you through the bond math to show what this actually means. It's a simple bond math. The higher the interest rate, the lower the bond or loans is worth. If you look at this bond math, if you issue a bond with a face value of $100 with an interest rate of $5, the price of the bond is actually $95.24. But if the interest rate that you require now is higher to 10%, the bond value is $90.91 based on the math. So as we can see, the higher the interest rate is, the lower the bond price is. What does this mean for these loans that we see on the balance sheet? In the past year, the Fed increased the interest rate, so we will see higher interest rate environment. These loans will be worth less, as we saw in the bond math. Most banks are valued 1 times the book value. According to the latest filing, the First Republic should be trading at about $18 billion. But that wasn't the case, was it? There are 2 main reasons why there was a gap between the book value and the price at which First Republic was trading. As you saw in the bond math, with the higher interest rate, the actual value of the loans that the First Republic made is lower than what we see on the balance sheet. So if you theoretically start seeing a large deposit outflow, the banks might be insolvent and cannot give back deposits to customers and clients. This was a classic bank run. This was possible, and it was reflected in the price. Let's then look at this math. Realistically, if the loans that the banks have made are, let's say, 85% of what we see on the balance sheet, given the increase in the interest rate, the loans go from $172 billion to $146 billion. The total assets decrease from $232 billion to $207 billion. But deposits and liabilities do not change. Every dollar that the client has put in, they have the right to get it back. The gap goes from what happens if the loans are worth less than what we see on the balance sheet. We can see it on the book value. It goes from $18 billion to negative $7.88 billion. What does this mean? This means that the bank is insolvent. Negative book value means the bank might not have the sufficient liquidity to return capital or deposit back to its customers. Look at this line item. Compared to Q4 2022, before the bank crisis happened, we see a huge decrease in deposits from $176 billion in Q4 2022 to $104 billion in Q1 2023. We see a deposit outflow of $100 billion. Caveat is that this $104 billion includes $30 billion of certificate of deposits that banks have made into First Republic. In reality, First Republic faced $100 billion of deposit outflow in the month of March and April. If that much deposit left the bank, how did the bank pay for it? You can see it from the short-term borrowings and certificates of deposit. They got $30 billion of certificate of deposits from banks, and they also got $80 billion worth of emergency funding from the Fed. The problem is that you have to pay back the Fed in 90 days, and the banks could take out the certificates of deposit at any time. With these issues, investors and the market thought the First Republic was delinquent and potentially go through a bankruptcy or a bank run. Post quarterly earnings, the stock tanked further due to liquidity concerns, and that led to the bank being taken into a receivership by the Fed and ultimately was acquired by JP Morgan. You might ask, who's at fault? Management team who put excess deposits that came to the bank during the low interest era might be at fault. Instead of keeping those as cash, they made a lot of long-term loans at a small interest rate, causing liquidity issue that we have seen with the negative book value. Also, I personally blame Fed to a certain degree because the Fed could have handled the situation much better after the failure of Signature Bank and Silicon Valley Bank. Either they could have raised FDIC limit to above $250,000, so high net worth individuals that had more than $250,000 at a bank would not have taken out the money, causing this liquidity crunch that we just walked through at First Republic. After the failure of these banks, people's trust in the banking system has significantly decreased. This is an institutional problem that the US will face. Who is the winner? Our good-looking Mr. Diamond. JP Morgan is the ultimate winner from this crisis. By banking laws in the US, any bank is not allowed to have more than 10% of total deposits in the US. Why? Because of competition. They don't want bigger banks to get bigger. They want more competition. But because First Republic was taken into a receivership, they get an exception. JP Morgan can acquire First Republic without being subject to this deposit limit. Now JP Morgan is the largest bank with over $3 trillion worth of assets. As a crypto investor, this is a boon to the industry because the trust in the US banking system has fallen significantly and people are going to take care of their own money. It is hard to believe and trust the middleman and the third parties. And that is the beauty of decentralization. Let's see where this takes us, but hopefully you enjoyed this video. If you like this, like, subscribe, and leave comments and ask me any questions. For Korean subscribers, 조댓글, 좋아요, 댓글, 구독, 알림 아시죠? I'll see you guys next week. See ya!